Well, hey there, everyone. Happy New Year. Happy 2026. It's Monday, January 5th, 2026. And I'm your host, Dave Keller, here for another fantastic year of Chart This with Dave Keller. Awesome to be with you. I hope you had a joyful, peaceful, restful, happy holiday season. And it's good to be back with you. I appreciate you being patient as I take a couple weeks off, be with my family, my daughter who goes to boarding school in Michigan, back in town here for almost 3 weeks, which was just awesome. We had a lot of wonderful time here at home doing things in this area, reconnecting with friends. We went to Mount Hood, did some hiking and snowshoeing, all sorts of good stuff. Back to reality, though. My son's back in school today. Daughter goes back to boarding school tomorrow. I'm going to Tampa for the CMT Association Midwinter Retreat. So if you're on the professional side of the technical analysis spectrum, you may find it to be a really, just time well spent, real good opportunity to connect with some peers in the industry. You can go to cmtassociation.org for information on their Midwinter Retreat in Tampa, Florida, coming up this Thursday and Friday. I'm excited to get down there and talk charts, reconnect with some awesome peers from around the country, and hope to see you there if it's a good fit for you and what you're trying to accomplish. Interesting day today. We're going to talk about this second trading day of 2026 after Friday being the first day. Today, kind of an interesting day and an important day for what's called the Santa Claus Rally. We'll talk about that 7-day period. Jumping to the punchline, didn't end where it needed to. We ended slightly below the watermark, the line in the sand that was set about a week ago. I'll share with you what that means and just kind of give you an update. But generally, strong update, generally for the markets, driven by not the growthiest stuff, but more financials and energy, with both had pretty strong days to the upside. We'll debrief on some of those charts and lots more as we can get to them here. Quick update, by the way, as I'm just realizing I didn't really put these in a proper order. You know what? We're going to go with it. Let's do it. It's my show. Here we go. This show, I'm a little rusty. It's been a couple of weeks here, but I'll get back into the right mindset here very soon. I promise. This show, we have 3 segments. We'll do a quick market recap, just talk about what the major averages and major asset classes did today on Monday's session. We'll look at the heat map and check in on some group and stock themes, and then we'll go to the charts and look at some individual names and some key charts to update for you. A lot of stocks to talk through today, to be honest with you. This is sort of a stock-specific day as I went through my notes. And again, what's interesting about this market here is the breadth conditions overall were quite strong, but in the last week of December actually lightened up a bit. So we'll look at some of those conditions here through the course of the day today, along with other charts. Let's get to it. So here, looking at the market recap, we can see that the S&P 500 finished up about 0.2%. 69.02 is your official close. We did get up to around 69.20, right around noon Eastern time. It sort of traded lower through the course of the day. So we actually got right back down to the open. There's a gap higher at the open, opening around 6,900. That's pretty much where we close. So morning pretty strong, afternoon session a little weaker, right? Just kind of a slow pattern of lower highs and lower lows if you're following the trading day during the afternoon. Mid caps and small caps all in the positive. The Nasdaq and the S&P pretty much the same return for today, and the VIX still very, very low. So we're in a low volatility environment. As I was working up a note for my market misbehavior premium members over the weekend, kind of getting set up for the January. Talked about how, listen, 2 big red flags that I've learned to look for when the market is in a strong uptrend: widening credit spreads, which tells you bond investors are getting nervous; increasing volatility, which tells you options investors are getting nervous. Neither of those things are happening right now. Credit spreads remain very narrow. Volatility remains very low. So as a result, conditions are still okay. Now, I'll tell you the biggest thing I'm definitely seeing is leadership rotation. And we saw that even today with a lot of the growthy leadership names, which struggled at the end of last year, kind of popping higher today, but not all of them, right? Microsoft kind of breaking down. Amazon testing its 200-day moving average. Tesla, not a great chart and starting to struggle a little bit. We'll get to some of those charts here in a little bit, but let's continue looking at the major averages. Here we can see the 10-year yield, long bond yield drifting slightly lower. Basically, the whole curve kind of drifted down a little bit. So the 10-year point currently around 4.17, long bond yield right around 4.9%, 5-year point around 3.7%. The dollar down slightly from Friday's close. So bonds moved up a little bit. Rates moved lower. The general trend over the last 6 weeks has been the opposite. It's been weaker bond prices, stronger rates. Looking at the commodity space, gold and silver continuing to impress. That was the class of the market in 2025. When if you look at returns through the course of the year, gold far outpaced most equities and certainly the major equity averages. Gold was up in a significant way, and silver up about double the returns in gold. I mean, and I don't have the official readings, but gold was probably like 50 to 60% higher. Silver was probably 120 to 130% up on the year. So, I mean, strong months. Now, the last trading week of 2025, both gold and silver kind of gapped down, kind of chopped around a bit, but the chart's still in a pretty constructive setup. And so we're seeing that long-term uptrend generally continuing here. Crude oil prices higher. Obviously, there's news over the weekend about the U.S. Involvement in Venezuela. And, we'll see what sort of ripple effects that could create. But for now, crude oil prices pushing higher. Energy stocks obviously moving higher as well. Tell you what, last show we did was in, mid-December of last year before the Christmas holiday. And as I was tracking the markets over the holiday season lightly, right, kind of lightly checking in when I could, I'm watching Bitcoin because Bitcoin certainly looked like it was breaking down in a big way, starting to recover a bit. Now, in the last 24, 48 hours, we've seen a dramatic improvement in Bitcoin. It was down around, mid 80,000, like 87, 88,000. It's gotten all the way up to almost 95,000 today during the equity trading session. So nice resurgence in Bitcoin. You can see all of the top coins here tracked on the stock charts platform in the green today. Could be an emerging trend because the charts of Bitcoin and Ethereum looked very underwhelming, going into the end of last year. Nice improvement now going into the new year. All right, looking at some sector movements, as I mentioned, there's more value-oriented sectors at the top of the leaderboard today. Energy, financials, industrials, materials, all in the top 5. So 4 of those are the big value sectors. Consumer discretionary, obviously a more of a growthy sector, up 1.7%. But energy and financials, number 1 and number 2. The energy sector, the best performer, up about 2.7%. Financials, the XLF, up 2.2%. Did my first weekly show on Stock Charts TV for the year earlier today. I think that should be posted by now. If not, it should be very, very soon. We talked about the financial sector in particular. Talked about banks, large banks versus regional banks versus market data companies versus insurance versus payment processors. Kind of looked at different segments of the financial sector, highlighted some of the charts because overall the sectors actually looked pretty impressive here and a nice start to the year with a lot of XLF members gapping higher today, one of the top performing sectors. So check that out on the Stock Charts TV YouTube channel if you want to learn more about some of my take on financials in particular. On the downside, only 3 of the 11 S&P sectors finished in the red. Utilities, consumer staples, and healthcare all down. Utilities, the worst performer, finished down 1.1%. Not a horrible day, but certainly not a great day. All right, breadth not bad today. You can see kind of a 2-to-1 ratio on the New York Composite Index. 68% of that index was up to 29% down. The S&P 500, about the same, 68 up, 32% down. On the mid-cap and small-cap index, kind of a 3-to-1 ratio, advancers over decliners. So stronger breadth readings, and I think that's one of those things you want to look for, right? When you have a market that's kind of threatening new all-time highs, the S&P just around 6,900, a little above there. If the goal is S&P, over 7,000 in Q1, if you're kind of all bowled up, I mean, things you would want to see would be like what we're seeing today with breadth, right? Improving breadth, I would say, is a super encouraging sign. And really, the stronger breadth just would speak to the fact that it's not just the big mega cap growth stocks that are doing well. That's more of a other things are doing well kind of environment, which is, usually what the stuff that sustain bull markets are made of. Our market trend model, if you haven't followed it over the holidays, finished almost bearish on the short-term time frame last Friday, but it remained narrowly in the positive. Friday sold off, but then kind of rallied into the close, and that was enough to keep our market trend model bullish on all time frames. So at this point, the trend, as measured by my market trend model using weekly data on the S&P, all bullish. Interesting, sort of a sign of the day here. You can see on the market movers widget, top 3 names, all in the energy sector, and about half the top 10 all in the energy sector. Valero, Schlumberger, and Halliburton all up over 7.5% today. Not a bad day. Looking at the Magnificent Seven and friends, we've got Tesla up 3.1%, Amazon up 2.9%, Meta up 1.3%. And a couple of those are pretty important, right? I think Meta, Tesla has been struggling here, so having an update is not a bad thing. Amazon and Microsoft are 2 names kind of testing their 200-day moving average, as is NVIDIA. Broadcom kind of getting down toward that area as well. Apple testing support. So a lot of these names kind of holding above support for now. Meta is actually below its 200-day moving average, just trying to break above. So I think these, again, whether or not you think this is the most important group of stocks in your portfolio, certainly I would argue an incredibly important group of stocks to be following. And I would say a lot of those have very important lines in the sand to track right about now. We'll highlight some of those here as we get to the heat map. All right, so looking at the heat map today, I mean, not a great day for technology. You'll see some random names that finished in the green, like Palantir, Lam Research, Applied Materials. But generally speaking, outside of some of those tech semiconductor names is what I meant. Outside of that, I mean, top 5 names in the technology sector, not great. Out of the top 10, only one of them positive, Palantir. The other top 10 technology stocks all in the red today. So not a great day technology-wise, but there was strength elsewhere. I would say in the financial sector, as I mentioned, I did that video for Stock Charts TV highlighting some of the strength across the financial sector. Insurance is the one area where you're seeing not as much awesome chart action. So things like AIG, not as good, kind of a failed breakout. Charts like CINF kind of failing to follow through to the upside. Lows with the kind of double top pattern, PGR kind of, well below previous highs. But, the average chart in the financial sector, either in a strong uptrend like a Morgan Stanley making new highs here in the new year already, or just starting to rotate higher after consolidation, things like Visa and MasterCard. And so I'm seeing a lot of strength in there. And the steeper yield curve, right, the improving interest rate environment should be a good tailwind, assuming that would continue here to come. Amazon and Tesla, the 2 big consumer discretionary names, both up about 3% today. I would say neither of those charts are awesome charts. They're both kind of good at best, but trying to improve. And I think that's an area certainly to watch. In healthcare, some of the big pharmaceutical names struggled a bit. Eli Lilly is the largest weight in the XLV, down 3.6%, kind of struggling after making a new high in November, kind of around Thanksgiving. Defensive sector is not great today. Consumer staples, probably one of the least attractive. Utilities, definitely the worst. Energy is a really interesting one, though, and this is one where it really helps to focus on which energy stocks are thriving and which ones are struggling. ExxonMobil made a new all-time high today, accelerating to the upside. Chevron just barely maybe making a new all-time high, kind of right up at those previous highs from April of this year. Up about 5% today. But then you look at like APA, still well below previous highs. Coterra Energy making a potential head and shoulders topping pattern. So not all energy stocks are created equal at this particular moment. I'm seeing a bit of a divergence between some of those. So just energy as a whole, not as great of an opportunity from a technical perspective as I would say some of the individual names. I think this is one of those times where it behooves you to really focus on which areas of the energy space are doing well here. I think that's it for the heat map. Shall we continue looking at some charts together? I picked quite a few charts here as first show back, so I couldn't help myself picking a lot of really interesting charts to share with you. So we'll get going with those right now. Here's our daily chart of the S&P 500. I didn't update this since our last show in December, but actually it was my last note to I think my premium members, but. Situation in the S&P, I mean, generally speaking, is this, if you had to pick, is this bullish or bearish? I would say still largely bullish. Our market trend model remains bullish on all time frames. I think that tells you, at least tells me, most of what I need to know about the general conditions. They're good, right? They're supportive for the major averages going higher. As we talked about in December, the S&P above 6,900 is a pretty strong chart because that means we are making headway above the previous all-time high. I would say that all-time high in October, for now, I'm considering that the peak. And I would say these two peaks in December are essentially retests of that October high. So until and unless we can get above 6,900 and kind of really, finish that move and follow through above that level, it's more neutral in the short term. But again, if I had to pick either bullish or bearish, the trend is more bullish than bearish here at this point. And the way that I would think of it, right? I mean, with charts like the S&P, I always think, is it innocent until proven guilty, or guilty until proven innocent? Meaning, is it in an uptrend and I'm looking for evidence that it's no longer in an uptrend, or is it in a downtrend and I'm looking for signals that it's no longer in a downtrend? And I think the S&P 500 is the former. It's still in a primary uptrend until we break the line in the sand, which for me is still 65.50. I think the S&P above 65.50 is still a pretty good chart. It's a good chart, right? Even if we chop around and have some pullbacks in here, it's still a pretty good chart. Breaking below 65.50, I would say it's not a good chart anymore. I would say that's a very toppy chart. That's some sort of topping pattern, or it's certainly showing renewed signs of distribution. But the RSI has spent basically the last 6 weeks between 40 and 60. This is still a market in a consolidation phase, at least on the short-term time frame. I think a break above 6,900 kind of completes that upside follow-through. Certainly a lot of investors looking for that here at the beginning of the new year. All right, let's talk Santa Claus Rally. If you follow the Market Misbehavior podcast, not prodcast, but podcast, by the way, we will be coming up with some new episodes of that podcast starting next week. I can't start this week because I'm traveling to Tampa. Hope to meet some fellow CMTs that I would love to invite on my show that we'll get on later this month and maybe into February. So hope to bring some new guests your way. But look forward to having a lot of great conversations with smart people talking about all things market related, along with other related topics. But I interviewed Jeff Hirsch, editor of the Stock Traders Almanac, in December. I would encourage you to take a look at that episode on my YouTube channel when time permits, because we talked about the Santa Claus Rally as part of a what he calls a January trifecta, 3 indicators that are important to watch at the beginning of the year. The Santa Claus Rally, to summarize, is basically a phenomenon that his father, Yale Hirsch, created and popularized, which was this 7-day period, the last 5 trading days of December and the first 2 trading days of January, which means we have to go back to the end of day on December 23rd. We start the clock there, and then we look at the 24th, 26th, 29th, 30th, and 31st. Those are the last 5 days in December, and then January 2nd, and today, January 5th. So where we would need to finish to be positive during that Santa Claus Rally period is around 69.10. That was the close of trading on December 23rd. We spent a couple days above that level. Then we spent the end of December, first trading day in January. That was last Friday. Well below there. Today we gapped higher. So about noon Eastern, I'm ready to hammer out a Santa Claus Rally successful. That's good sign for January and a good sign for risk assets. The bad news is the afternoon sell-off actually took us below that level. Yale Hirsch created the catchy phrase, if Santa Claus should fail to call, bears may come to Broad and Wall. Broad Street and Wall Street is the corner in New York City. If you're not familiar with the city, that's where the New York Stock Exchange is located. It's kind of the end of Wall Street where all the major banks were. Now they're kind of spread around Manhattan and elsewhere, but at the time they were kind of all right there. Right around the New York Stock Exchange. And so the idea was, if during this 7-day period, if there is a positive return, that's a good indicator for market conditions. If that period is weaker, that's a bad sign. And unfortunately, it was very, very close, but by my reading, finished in the negatives. That's actually not a great start to the year. The Santa Claus Rally not fulfilled. We'll see if we continue to see a risk-off move in the days and weeks to come. But for what it's worth, that traditional seasonal measure finishing more negative than positive. This is a chart I simply call the chart, just looking at some of the major factors to follow in terms of assessing conditions for the equity space. I just want to run down where we're at. Here's the S&P 500 at the top, as we mentioned before, consolidating, but generally speaking, heading higher. The breadth on the New York Stock Exchange is pretty good. I'll be honest with you. Advanced decline line is above its 50-day moving average. We're not quite making a new all-time high today, but we're pretty close. Very, very close to pushing above previous highs. So, the advanced decline data is actually pretty supportive here. It tells you certainly in the month of going into the month of January, we're in decent shape. Stocks above their 50-day moving average around 63%. That's 2-to-1 ratio of stocks above versus below their 50-day. That's good. And it's not excessive. It's not too high where you start to worry about some unsustainable move. It's pretty good bullish reading. Bullish percent index on the S&P 500, which is a market breadth indicator based on point and figure charts. Bullish around 62%. That's good. Offense over defense. This is consumer discretionary versus consumer staples using equal weighted versions of those two, has been trending higher for the last 6 weeks. So top to bottom, these are all bullish readings here, which means using a chart like this is quite helpful because at some point, they're not all going to be bullish. And I think with each one of these, there's a very clear level at which you can say, this is no longer constructive. But at this particular moment, I would say the conditions are pretty good. I think this is saying the market is in decent shape here. Speaking of charts in a decent shape, Bitcoin improving quite a bit. And this is really just the story in the last couple days. Kind of over the weekend, I was looking at some charts getting ready for my premium members and, noted how Bitcoin was starting to resolve to the upside. End of last year, Bitcoin's below 90,000. And I would say, until we can get above 90,000, until we get above the 50-day moving average, like why even worry about Bitcoin? Focus on other stuff as long as the momentum is relatively weak. What's happened now going into today's equity trading session, the momentum has improved. The RSI finished the equity session above 60 for the first time since October. We're threatening to break above the December swing high around 94,000. That's all encouraging. So I would say the chart of Bitcoin, which was very neutral going into the end of last year, so far in January has improved quite a bit. So I currently don't have a position in Bitcoin. I'm right at that point where I'm starting to think about at least taking an initial position in Bitcoin, but probably through an ETF. But for now, impressive improvement. That's something we talked about back here off of the April low. What convinced us that Bitcoin was in a strong uptrend was a break to a new swing high with improving momentum. And we're very, very close to that new swing high. We've already got the better momentum. Bitcoin could end up being one of the interesting early trades in 2026. The GBTC, which is a Bitcoin ETF, just want to show that it is currently testing its 50-day moving average. The price is just at its December swing high. That's around $74. The RSI is not quite to the bullish reading above 60, but very, very close. So the chart at GBTC, it's what I'm watching as well, up 5% today, but close to breaking to a new swing high, which again, I think would be pretty constructive. All right, let's finish off looking at some individual stock charts. I mean, again, while the conditions are pretty good, I would say the conditions of the Magnificent Seven stocks not particularly great. And this is awesome. I mean, if we see the market moving higher and stocks like Apple aren't leading, I think that should be very encouraging because one of the biggest skepticisms, and I think rightfully founded in 2025 at times, was the fact that it felt like the market leadership was very narrow. And at times it was different, but certainly during periods, it felt like it was the Magnificent Seven doing well and everything else was struggling. That was certainly the point. What we talked about in the fourth quarter was how that picture was changing quite a bit and how some of the Magnificent Seven stocks were no longer leading, how that leadership was changing. And I think that was one of the big changes in the fourth quarter. And the question for Q1 of this year is if we see continued upside in the markets, and can it happen without some of these leading growth names? And for now, we're saying, yeah, it actually might be able to. Which also means if you've been sitting on an overweight in charts like Apple, pretty close to the point where you may want to be reconsidering that overweight and think about where your capital is best placed at this particular moment. Apple is testing its line in the sand actively. 265 is the level that we've noted from the November swing low and really the December swing low as well. We actually finished there on an intraday basis today. So Apple right at that point. I have an alert set, something I'm watching here as well. Microsoft finished Friday's session closing below its 200-day moving average for the first time since April. It's actually kind of holding that level right about now. We have a Fibonacci support level. We have the 200-day moving average. We have the November and December lows all around 470. We're very, very close to breaking down there on the chart of Microsoft. The momentum has been pretty underwhelming for about 6 to 8 weeks here. Palantir, I mean, not a horrible chart, but just not a great chart anymore, right? The all-time high in Palantir came in early November. We basically retested that high third week in December and failed. Now we're back below the 50-day moving average. So the long-term trend has been impressive, but here in the last 8 weeks, there have been much better places to be. I would say the chart of Palantir, to be honest with you, like another chart, I forget the other one that I grabbed, so I won't guess at what it is. Something else. Palantir is kind of in this symmetrical triangle pattern or coil pattern. That's a pattern where you have lower highs and higher lows. We're consolidating around an equilibrium price. In some ways, one of the easier technical patterns to trade because you just wait for a break out of that pattern, a break above the upper line or a break below the lower line. I would say at this point, it's unclear from the chart which of those is going to happen. But I would say breaking below the lower line would be an initial warning sign. Breaking below the 200-day would also get below that November swing low. And I think that's where Palantir looks like a pretty underwhelming chart very quickly. Micron, a bit of a distribution day today after a higher open and closing slightly lower, but the trend overall is still pretty good. We did make another new all-time high today. So semiconductors generally still playing quite well outside of NVIDIA. Some of the other ones still looking the best. And Micron probably has one of the better charts out there, still in a strong position above upward sloping moving averages. You can't say the same for Meta, which has been below its 200-day moving average for quite some time, actually, since the end of October when it gapped down below the 200-day moving average on its earnings release. We've remained below that level. Look at the 200-day right around 672. Look at this Fibonacci resistance level here around 680. It's the lower end of this price gap. There's so many levels right around 675 to 680. I think Meta above 680 is a really interesting chart. Would want to see RSI above 60, but for now, kind of languishing in no man's land. So for me, it's still a wait and see chart. This was the other symmetrical triangle actually for our last chart of the day that I wanted to highlight. Similar to the chart of Palantir, you've got the symmetrical triangle pattern. Again, kind of a classic chart pattern. Higher lows, lower highs. We're settling in and around an equilibrium price. You can see the moving averages are kind of flattening out here. One of these things is going to happen probably pretty soon. We break above the upper bound or we break below the lower bound. And whichever way we break, that's probably the direction of momentum and most likely the next leg in that key chart. Folks, that'll do it for today. Great to be back doing the show. Boy, I'm a little bit rusty, but I hope this all kind of comes back very, very quickly. I did do some minor changes to the background. New lava lamp. Thanks to Mrs. K for that Christmas gift. I'm loving it. It's actually in market misbehavior blue, which I think is pretty killer. So I'll try to remember to keep that up and running for the show here every day. But for now, I'll say thanks so much for tuning in. Thanks for bearing with me this week. I'm going to be traveling to Tampa tomorrow. We'll be there the remainder of this week. We'll hope to do a show every day, though. Time permitting, I'm just going to have to find time in the evening Eastern time to get this out to you guys, but I'll do my best to do so in a timely manner. In the meantime, I wish you a happy new year. I wish you much success this week and for many, many weeks beyond. Please drop questions in our comments section. Like the video if you wouldn't mind. Questions are helpful because we're planning an all mailbag episode on Friday this week. We love to answer one of your questions on the show. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll see you tomorrow.